Hi, small business owners. King of Lending here. Alex Wigginton wanted to talk today about lines of credit. One of the most requested instruments from my clients on a daily, weekly basis is a line of credit. I'm going to talk today about a few reasons why they're a really good complementary instrument for your business. And why you should probably seek them out and kind of affirm that. And then also, maybe a couple things you didn't know about them. First, I want to talk about the line of credit itself. So, fantastic instrument. It is a revolving line. So let's just say hypothetically, you applied for one and you got approved for, say, a $50,000 line of credit. Essentially, it's money sitting there waiting for you to use in any capacity you see fit. And you can draw from it. As you draw from it, obviously the amount that you have available goes down. And then you start that payback period right when you draw from it. And an important note here, one of the reasons why it's so sought out, your interest cycling starts on the amount you draw when you draw it. And so if you draw out $5,000, you're going to only accrue whatever the interest rate is cycled through on a yearly basis. So let's say you get a 12-month line of credit. You're approved for a $50,000 12-month line of credit at 5% interest rate. Let's just say 10%. We'll make it even numbers. And you'd go and you draw $5,000. Well, then it's going to start that cycling on your interest rate at that amount at $5,000 upon that amount, and it's going to only be your monthly interest rate. So 10% divided by 12, what is that, 0.8? Is what you'll get. So each month you will only accrue 0.8% on that interest rate factoring piece. As it goes along, the longer you leave the balance there, the more you'll pay on it, obviously. But in scenarios where you need quick cash, say you need the $5,000 for equipment, or you need it for just a supply order, you can draw that $5,000. And if you have an invoice or PO or anything that comes in after 30 days, you could potentially pay that off within a month or two and not pay anywhere near the actual yearly interest rate structure on it. So it allows a lot of breathing room, a lot of ability to pull your cash out when you need it. Because of that flexibility, the caveat to that, I want to talk about underwriting a little bit. With underwriting, it's going to be a little bit harder to qualify for one because of that. Essentially, a lender is underwriting for a year or two, looking at your business and saying, if all things were equivalent, could this business survive a downturn? So let me give you a scenario. Let's say you have 10 regular customers. When a lender is underwriting it, they're going to look at it and say, what is the hypothetical that this business, although it has 10 customers and they're very regular, very consistent and stable customers or clients, what is the propensity, or what would happen if they lost 5 or 7 of those? Would the business be able to still handle the payments on the line of credit that were due if it was maxed out? So again, let's say you get a $50,000 line of credit. They're going to look at, okay, you lose a half or a majority of your clients. What is the ability for you to actually maintain that and hold it and make the payment on the $50,000 if it was fully drawn out? Additionally, on underwriting criteria, your credit scenarios. So for private lenders, you need a credit or FICO score average of usually around 680. The higher the better, of course. That's just the way these things work. 700s, 720s and above obviously are very good. But the higher the better. There are private line of credit lenders that will look at 660, 680 range. When you start getting below that, it's going to be harder to get qualified on one for sure. There are some things that can push it across the board that I can talk about more in another video to give you a little bit more clarity, but aim for 680 for sure. And then another thing is you want to think about time in business. On the underwriting side, lenders are going to be looking for, how long has this business been around? Are they stable? So if you're a year in business, it's going to be really hard to qualify for one. But if you are at least 2 to 3 years in business, you'll have some qualification ease there. Ideally, because of the economy and the rates being raised, they have pushed some of the underwriting criteria up a little bit. So they like to see 3 years in business. But there are some scenarios where 2 years in business qualifies as well. And then next, I want to talk about revenue. Revenue is going to be one that can vary, but in general, I want you to think of it this way. $25,000 per month in revenue is a good starting point. If you're making 5,000 or 10,000, it's going to be extremely hard to qualify for. But if you are making 25 and above, of course, the same thing that applies, the more the better. But if you're making 25 to 30,000 range, you're going to be able to start opening doors. 50 to 75 or 100K per month, absolutely. You would be able to qualify. The next question would be, what is your industry? Of course, it's going to roll into the other underwriting pieces. What's your FICO? What's your time in business? What's your industry? And then, what's your revenue in the whole scenario? So to kind of recap everything, line of credit is a fantastic instrument. I recommend them for most of my clients. I help out in the private line of credit industry or lender industry. I've got lots of partners. It's really a great instrument to help complement your business in every way possible for your growth. It doesn't pull down on your revenue a lot. It doesn't pull down or affect your cash flow a lot, and you control it, and it's there to draw whenever you want. I hope that this has been helpful for you as a small business owner, or just a business looking for some growth capital in any ways. Of course, comment, like. I'm happy to take one-on-one sessions, discuss anything needed. Again, looking forward to learning more about your business. King of Lending. Thanks.